Welcome to episode 6 of Office Hours with yours truly in partnership with The Loft. Today we have yet again a unique episode, and I'm welcoming Jonathan Prince, who is a very well-known fintech entrepreneur in Luxembourg. And we are going to discuss the best practices, the do's and the don'ts to start a fintech startup. And a fintech startup is a very unique animal, and that's why you have to understand the fintech part, because there's a fin and a tech part, and it's unlike any other traditional tech startup. First of all, Jonathan, welcome. Could you introduce yourself to the audience in a few words?
So I'm Jonathan Prince. I'm one of the co-founders of Finologee. So that's a fintech, regtech company located in Luxembourg. We serve many financial institutions, mainly in Luxembourg, but also in 8 other European countries. We help them with KYC, AML, mainly, and also around payments. And we actually were able to build the APIs for the banks to comply with PSD2 and also the account reporting obligations that is in the context of AML5. So we've lucky enough to be able to onboard roughly 35, a bit more than 35 banks in this context. So
and when did you start Finologee?
We started Finologee back in 2017, so 5 years ago, and in fact that came after the DigiCash story. So with my 2 business partners, Raoul and George, we launched DigiCash 10 years ago, and the idea was there already to partner with banks to serve the end clients with an application for them to be able to pay in shops, to transfer money and so on. So that was really our first experience in the payments, regulated payments area, and but before that actually, so 16 years ago, quite a long time ago, these 2 guys started Impulse, and I joined them 12 years ago. And Impulse, not being in the regulated sector, but working with telecom operators and also doing micropayments and messaging. So that's 3 ventures.
Not only are you a fintech entrepreneur, but you're also a serial fintech entrepreneur. 3 startups, yes. Finologee being the 3rd and latest one that you're operating with your 2 partners. Absolutely. So you're gonna have to share the wealth here, right? We're here to tell the audience what are the do's, what are the don'ts, what are the best practices, the things to avoid, the things to do. So,
yeah. So first of all, I think something that is very important. We always define entrepreneurs, right? And I think that is clearly the most important part. So someone who's actually an entrepreneur is someone who's taking risk, who has skin in the game, who's putting money. So you're yourself taking some risk. So sometimes we hear this is a great startup, fintech startup, but it's actually not. It's a bit different. It's a subsidiary of a bank. Mm-hmm. Here, I think the most important part is that when we talk about fintech and startups, that means that there is a commitment from the founders. They are going to put their own money. And obviously, if they want to raise money, the venture capitalist can share some of the risk with them, but that comes later. So first, it's a personal commitment to take risks, to build a company, and people that you're going to employ will rely on you. So that is the first thing. And then you said so. Fintech, I think, is a specific, and it's a particular breed because it's obviously regulated, so there it requires to have some experience, first of all, but also to be very conscious of the fact that you're going to work either in the B2C mode with people who are going to trust you and probably rely on you to either handle their wealth, money, or you're going to do payments, it's going to be money transfers and so on, but that requires that you have put in place everything to secure the business, to mitigate the risk, And it's also true in B2B. So if they're going to rely, if a bank or any kind of financial institution, being an insurance company, a fund, is going to rely on you to help them with KYC, AML, or payments, so specific obligations that they have, and they're kind of going to rely and transfer part of what they're responsible for to you, you need obviously to make sure that you provide the right framework for that, that you have the right environment, technical but also compliance-wise.
I think that's a very important point. So let me rephrase and repackage off of my own view of like having invested in fintech startups for like 15 years, right? So there are those fintech startups that are regulated themselves, right? Because they handle monies or make transactions around monies in a certain way that they have to be regulated. Whether it's in the payment space or in wealth management or in insurance, they're regulated. And then there's those fintech startups that are not necessarily regulated, but that sell their solution to regulated entities.
Correct.
Right? And that's a not so well understood point, right? Especially for first-time entrepreneurs, that by default say, you know, I'm in the tech business, I'm developing a tech solution, and I'm selling to banks or insurance companies, and so I don't care about the compliance. But that's not necessarily the case, right?
No.
You have a B2B business, Finologee.
Correct.
You're regulated, and you're selling to regulated entities. So you have like the worst of both worlds, or the best of both worlds. How do you make that worst of both worlds into a best of both worlds? Because you have that regulation, you know, component on your shoulders.
No, I think it's key. So regulated entities, financial institutions, have to comply with different regulations, laws, and so on. And clearly, once more, the key element here is to mitigate the risk. They're managing the wealth of other people. And in that case, they have their own obligations. And in terms of outsourcing, when they want to rely on a supplier, such as Finologee, they need to do a thorough due diligence on their providers, right? So that means make sure that the provider is actually, can financially support the service they're going to provide for some years. So they're going to check whether the finances of this company are in good shape or not. Secondly, they are indeed going to assess whether the technology is, first, if they're interested in it, but obviously also if it follows the requirements of the law and the regulation. So they're going to do this analysis there. And in terms of IT security, obviously there is a big chunk of the due diligence they're going to do there. So we have a big advantage in Luxembourg with the PFS license, where we are ourselves regulated. So that means that we have the same obligations and the same level of audits as our clients, which are financial institutions.
Goodness. Is that an advantage? I mean, that's like very cumbersome.
For us, probably not, in the sense that it does, or some people could see it as, you know, a disadvantage, but I reckon that it's very structuring, creates substance also, because you then understand a bit better your client's obligations, and you also put in place some procedures that are very structuring, in the sense that you organize your IT, your infrastructure, according to their own obligations, meaning the client's obligations, but the law, and then you can provide it in a SaaS mode, as we're doing with most of our platform, which makes it easier and probably less expensive for a financial institution to consume, because a deployment on-prem sometimes could be a bit more difficult, also in terms of the procedure to deploy it, but also in terms of costs. The financial institution would then have to operate it. There in a SaaS mode, it's easier because we would operate the platform.
So put yourself in the shoes of an entrepreneur with an early stage startup. It's not Finologee, right? And that is selling to the financial sector. What's your advice in terms of like thinking about all these things? How can or how should the entrepreneur go about solving for all of what you've discussed, right? The vendor selection, the cybersecurity issues, the data issues, is your technology mature enough? Are you going to be alive tomorrow after what's your advice for that person or that group of people that are engaging in the journey?
Well, actually, are you going to be alive? And everything that you mentioned there, the CSSF is based on the audit you get. They are checking whether you are going to be alive or not. So they do this assessment with the PSF providers. So that is something that the banks don't have to do then. That's probably easier. Still, considering from the perspective of the entrepreneurs and the startups there, my recommendation would be to first check whether there is a fit between the financial institution's needs, requirements, and your product.
Okay.
Does it fit? Well, it's obvious,
sure,
but it's not always true. And I see a lot. I participate in the Kickstarter project, Catapult Kickstarter, and so on. So I meet quite a lot of startups, and my recommendation is always, you probably think that your product is the greatest, that your product is absolutely brilliant. Still, you need to consider what your client, being the financial institution, is how they're going to actually integrate this product. Does it actually fit with their own organization, the way they structure the data, the way they operate these platforms? Does it actually fit? So it's not just about your own product, but the fit with the way the banks operate and distribute whatever product it could be. It could be a service, could be a product, obviously. But it's very important. If you don't understand the constraints your client have, then there will be a mismatch.
And so I'm sorry to interrupt you, so I really understand the point that you're making, right? If we're in another industry, in like deep tech and social media and so on and so forth, what you're saying is that those other industries, right, are more willing to adopt something that is drastically different because they don't have the constraints that a bank or an insurance company has. And the way that a bank or an insurance company operates is not by chance. That's what you're saying.
That's it.
It's because of the constraints that are being put by legal means or regulatory means.
Exactly.
And so your product has to be cognizant of that. Else, even though you think that it's a good product, you're not going to be able to sell.
That's it. You've got to take into consideration the fact that a bank is operating on an infrastructure, an existing infrastructure, and that the language that is used is probably very different. If we're talking about microservices, technologies such as Kubernetes and so on that but that's probably doesn't fit with the, I would call it, legacy infrastructure that a bank is operating on. So do they actually have APIs, endpoints, and all that? You need to first assess whether that is...
The technology architecture of a financial services incumbent, it does not spring out of nowhere.
No.
It springs out of constraints, I repeat myself here, and those constraints cannot be removed because they're mostly regulatory or legal for that industry. And as a fintech startup, you really have to understand this over and above the value proposition, the product, the service that you're bringing about.
Absolutely.
Which is kind of like table stakes for like any startups.
Absolutely.
So that's your number one advice for the entrepreneur.
Number two, do you have the stamina?
They all do. They're listening to us.
Yes. But that means, do you actually have the funding to support? A procurement process is very long. It is. So, some expect in their business plans to sell within 3 months. That's wrong. Forget about that. it can't be. Because as we were mentioning for the tech part, the requirements and the constraints a bank would have to actually assess and do the thorough due diligence on a provider is huge. So it's going to take them at least between 6 months to 12 months, if not more.
Okay.
So you need to make sure that you actually have enough funding to be able to hold this period of time and be able to actually get to the implementation and integration phase.
It's pretty much like not only the funding, but it's like on all aspects of your roadmap. It's not like 3 months or 6 months. It's like 12 months, 18 months in order to succeed.
Not more, yes.
That's probably the top two pieces of advice. I'm gonna turn the question around. What's your top advice for financial services incumbents when they look at a startup that they want to engage with?
Yes.
What should they look for?
Okay, what they need to first assess whether they're actually organized to work with a third-party provider and not a traditional player. I mean, there we're talking about startups, right? So the risk aspect in their own way of reading it is going to be obviously higher because it's not an incumbent player in the supplier industry, and so there they've got to come with a very open mind. Secondly, I would say you need to have an internal sponsor. You need someone who's actually going to lead the task force, because it is a task force. It's going to require experts from risk, cyber security. It's going to experts from the compliance, the business, obviously, and the tech. So if you don't have someone who's going to take the lead, someone who's going to be the sponsor, then everyone will come. All of these departments are key.
One after the other.
Yes, and so that is going to make it a very heavy process for the startup, and they won't be able to actually get to the end.
Summarize the first, the top two. One, think outside of the box for an incumbent, and then two, have a champion / lead that kind of like translates the different types of languages and coordinates so that the incumbent is able to digest as much as possible that startup, which by definition is a completely different universe.
Absolutely.
That makes sense. Any parting thoughts for our audience? Any other pieces of nuggets that they should follow?
Yeah, I always tell the startups, think about protecting your IP.
Okay.
That's key aspect, because for a bank, to mitigate the risk, they might ask for some clauses, specific clauses that they can claim ownership on the IP and so on, which actually most of the time they can't do much about. If the startup was to go bankrupt, they could not do much without it. But because it's standard templates, they sometimes ask, to have some clauses, specific clauses to take over the IP. I think in general terms, for a startup, it's your main asset. The IP is your main asset. People obviously always key, and we always say, the team is very important. Still, people tend to change, move, so you will have some turnover, you will have some churn, you will have people coming, leaving, and so on. Maybe the founders will stay for a while, but you see also some co-founders leaving at different stages of the evolution of the startup. But the IP is the main asset. Protect it. Just make sure that you actually have the right experts to help you with that.
All right. So that last piece of nugget, right? Obviously sell to incumbents if you're a B2B fintech startup, but protect your IP as much as possible. On that note, Jonathan, thank you very much for accepting to come to this show, to this office hours. That was a great episode. I enjoyed it. Thank you again.
Thank you.
And ladies and gentlemen, until the next episode of Office Hours, I hope that you've enjoyed this show, and bye-bye for now.
Bye.